Short-term market direction always operates on a specific mechanical logic, continuously being pulled toward zones of dense liquidity. Quantitative traders track these zones using liquidation heat maps, a diagnostic tool used to pinpoint exact levels where opposing traders are holding over-leveraged positions. Over a 7-day window, the price action weaves across the chart, moving directly toward and consuming these highly concentrated bands. This static frame of the heat map captures a specific climax point in that continuous cycle. On this topography, the brightest yellow bands signify the highest concentrations of forced orders waiting to be triggered. By forensically tracking this exact 7-day period, we can map how the accumulation of these leveraged positions builds predictable magnetic zones. Price action reflects a measurable algorithmic hunt for counterparty risk. This chart shows the liquidation heat map starting on July 16th. The market is in a state of relative equilibrium, ranging tightly. The bottom x-axis tracks the chronological timeline, while the right y-axis maps the standard asset price. The critical metric is on the left side, the liquidation leverage volume. This represents the total dollar amount of forced liquidations resting at specific price levels. The immediate boundaries framing the current price are clear. High-leverage short stops are clustered near 66,000, and high-leverage longs sit around 64,000. Price is trapped between these two gravitational pulls. Identifying them is the required first step to mapping the playing field. Initially, the asset ranges tightly, oscillating between the 64 and 65,000 markers. During tight consolidation, traders who open highly leveraged long positions place their stop losses directly below the current price, creating a pocket of vulnerability. Moving into July 17th, the market breaks that tight range and initiates a sharp downward trend. The price action pierces through the 64,000 support level, pushing aggressively toward the 63,000 marks. By the later hours, the price hovers directly above a major liquidation cluster at 62,000. This downward dip executes a sweep of that lower liquidity tier. It hits the stop losses of the over-leveraged longs that built up during the previous day's consolidation. Wiping out that bottom-heavy leverage clears the board of weak long positions, shifting the directional pressure of the entire market. That initial downward drop acts as bait, encouraging retail traders to aggressively short the market in anticipation of a deeper breakdown. We can see the immediate result of that short-selling behavior mapped on the heat map data. Notice the distinct, heavy thickening of the upper yellow bands forming between 65 and 66,000, while the price continues to consolidate near 64. This dense new cluster represents a massive pool of latent buy-side liquidity. To close a short position, a trader must buy the asset back. Mathematically, a forced short liquidation is automatically converted into a market buy order. By shorting the dip, retail traders unknowingly construct the exact liquidity pool that algorithms target next. Large volume algorithms require massive counterparty volume to execute their trades without causing severe slippage. They rely on counterparty matching, the algorithmic engine actively seeking out the highest density of opposing orders to absorb large blocks of capital. When the asset's price touches one of these dense yellow liquidation bands, it triggers the first wave of short liquidations. This sets off a cascading chain reaction. The forced market buys from the first liquidations drive the price up, which instantly triggers the next higher band, propelling the price into the next level. The vertical price spike is the mechanical execution of a chain reaction, fueled by forced buys. Returning to our historical dataset on July 20th, we can observe the exact moment the massive upward breakout officially begins. The price reverses its trend, climbing rapidly out of the 64,000 range. It ascends directly into the thickest magnetic yellow bands that were established earlier in the week. Hitting this high concentration band at 65,000 provides the forced buy fuel required to maintain the vertical momentum. Advancing to the climax of the sweep on July 21st, the final highest concentration target is hit. The price spike terminates precisely at the final heavy yellow line at 67,000, physically validating the cascade physics. The data shows that this 3,000-point vertical move tracked the magnetic pull of the liquidity accumulated over the previous 3 days. On July 22nd, the heat map reveals a new configuration of liquidity following the sweep. The dense upper bands that acted as the target have been entirely consumed. They are cleared from the map, leaving only dark, empty space. Advancing to the final state of our dataset, we can analyze the newly formed environment. Heavy new yellow bands have formed directly below the current elevated price action, concentrated between 65.5 and 66,000. The cycle has immediately reset. Having swept the shorts, a massive new pool of high leverage longs has formed trailing the breakout, becoming the inevitable next target. The ranging accumulation cycle is continuous. The market ranges, it builds dual-sided liquidity, and it sweeps the denser pool. While heat maps are highly accurate at mapping the terrain, they cannot predict the exact timing of the sweep. Their strategic value lies in revealing the algorithmic playing field. They strip away the noise of traditional chart patterns to show where capital is truly trapped. Attempting to navigate modern cryptographic markets without visualizing these magnetic leverage zones is equivalent to trading blind against predatory algorithms.